and welcome. Today I will be talking about trading high velocity moves with an algo approach in the first 2 hours of the New York trading session. My name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm that it is specialized in educating individuals how to day trade and swing trade the futures and the equities market. I have been trading professionally for the last 17 years, and my focus is day trading futures in the first 2 hours of the New York trading session and swing trading stocks. Prior to becoming a professional independent trader, I come with 10 plus years in investment banking. I'm also the designer of an institutional proprietary trading system, and the reason I'm the designer is because I cannot take credit for it. Trading analysis has been around for a very long time, but I have found some interesting correlations in the market, and I was able to redesign a system based on technical analysis that enables me to find and trade high velocity moves. The system is based on price support resistance. I'm not going to go in depth into price support resistance. However, my system is based on 7 layers of price support resistance. So not only just support resistance from price action, but actually 7 layers of price support resistance. Specific trigger times that are happening for the New York trading session. However, I'm going to mention some of these trigger times in today's presentation and show you how exactly they work. Specific price zones, there are 4 specific price zones on charts where actually 4 precise price points on charts that determine institutional buying, selling, or profit taking. I'm also very keen on using synchronicity and divergency in the market because this is one of the biggest components when you're looking for a trade with a very high velocity outlook or outcome. I want to initiate trades, day trades that literally represent instant gratification that allow me to have access to that instant gratification. I don't like the trades where I sit in them for a very long period of time. And I'm going to share with you some of these timings in the market that allow you to actually find, locate, and execute these trades. Also, relative strength and relative weakness is something that I look into the market, and especially in today's market where you have a lot of divergency and a lot of things that are happening. One of the reasons why a lot of my trades consisted in the mini Nasdaq, and in fact, we did have a swing trade in the Qs that I'm going to share with you today, was because the tech stocks held the best. So it was transferring some of that strength and energy into the index and had best probability for a velocity move higher and therefore for a more fluid move to the upside. I also trade with a very strict set of trading rules and a 10-point scoring system that enables myself and my traders to identify trades with ease and also to manage trades with ease and stress-free. If you want to get a hold of us, you can visit our website. It is TradeOutLoud.com, or if you would like to follow us on social media, the handle is TradeOutLoud. And in particular on Twitter, I do post the levels that we're going to be discussing today, and these are algo levels. And I post them every day on our Twitter feed, which is twitter.com/TradeOutLoud. In today's presentation, I will be talking about algo trading and how we transfer algorithmic trading into our methodology. I'm going to talk about futures 101 and why I trade futures and what I trade. And I'm going to talk also about building the foundation for the next trade, identifying trades based on pure price action, and more. Okay, so I do have a lot of surprises for you guys today. So I want to start off by saying that in trading, there is literally no room for average. The average, if you look at it, it's nothing else but the top of the bottom and the bottom of the top. So you have to be a very well prepared trader in order to tackle the markets. The order in which you need to approach trading is first, education, second, practice, and then last, open a trading account. You have to have a lot of practice, you have to have a lot of knowledge and market understanding before you actually open the trading account size. We are into a very fortunate industry, all of us in here. We are trading, and our footprints are in an industry where we can profit in any market condition. We can trade any market condition. We can trade a bull market, we can trade a bear market. It is literally a recession-proof skill. About 3 weeks ago, the CME closed the trading floor, and went 100% electronic. 2 weeks ago, the New York Stock Exchange did the same thing. So literally this industry is ran by algorithms and computers. And I'm going to emphasize the importance of actually adopting an algorithmic method to your trading. Even if you do not have a preset algo, it is important to know that you can actually trade like an algorithm, and I'm going to share with you how. And we do it every single day, and I have been doing this for many, many years. A bull market is a very easy market to trade because you basically buy any kind of pullback. And I know how scary it was back in 2018, where we had a lot of volatility come into the market for the first time in a very long time. And that was in February 2018. February and March were very volatile months. And that was the case of, yeah, you're going to buy the dip because you're trading in a very, very strong market. Things changed with this market right now, market environment. We're basically trading into a pandemic market environment, into a black swan type of event. You can see how the market is reacting, panicking on every single announcement. That is the fear that is literally overwhelming price, and it's making the price drop. Are we in a recession yet? Well, we need just 2 GDP numbers, 2 consecutive quarters of decline in real GDP in order to be in a real recession. Oftentimes, by the time the market reaches that specific level of recession, we're literally out of the recession, okay? So that should not scare you. In a recession, the price tends to downtrend. Now, having lived through some very severe downtrends, and that is in 2018, where we had a very volatile spike to the downside with 3 consecutive negative months, that is October, November, December. Also trading the QE years, also trading the steep decline that we had in 2008. And by the way, the 2008 decline, I don't know if we have time in today's presentation, but the 2008 decline was basically a revisit of prior support zone that we had a few years back. So we were still trading into an uptrend into that 2009 low, which is very interesting. And I've also traded on the investor side, the 2000 to 2002 decline. That was the tech bubble. So we had the tech bubble, we had the financial bubble, then we had volatility right in 2018, and now we have pandemic. So it's very hard to trade to the short side, especially if you're on the swing side, right? It's easier to trade, it's always easier to trade it to the upside. For traders, volatility is an opportunity. Why? Because it creates the fluidity to run to targets, bam, super fast. That is when you get your instant gratification. For investors, any kind of recession is actually a huge opportunity because you can make yourself a list of stocks that you wanted to hold since 2009, right? Or maybe since 2018, and you can actually have a better price. You actually can get those stocks at a discount price. So I want to mention that I love the participation on algorithms, and I'm all for algorithmic trading. Why? Because algorithmic trading represents more than 87% of the market. We as traders and other portfolio managers and other hedge funds that trade manually represent the rest, so a very small percentage. Why do I love algorithmic trading? Well, think about it this way. Someone had to program that algorithm to react at certain areas, right? So we just need to decipher what are those areas that institutional traders are looking at. And I was able to decipher exactly that, and I'm going to show you some charts that prove that and prove the method to the test. Because remember, if you were an institutional trader, then you had access to information. And even if you're a technical trader, you have access to part of the information from technical analysis from which you could actually determine your algorithmic levels, the levels at which the price reacts to. And there are levels where the price doesn't react as much, and actually levels where the price reacts in a very dynamic way. I was mentioning earlier that I like to look at higher time frames. Higher time frames are more likely to have a sustainable approach rather than smaller time frames. And when I day trade, and I'm going to share with you the trading timeframes that I trade on, I always take my bias from very high timeframes. Always get my bias from very high timeframes. And I developed a methodology where I'm getting my information from the higher time frame and I'm applying it on a really micro level, on a 1 minute, 2 minute, 5 minute, or even 15-minute chart. So what is an algorithm? An algorithm is a specific set of clearly defined instructions aimed to carry out a task or a process. So if you come to think about it, what is that set of clearly defined instructions? Isn't it a trading plan, right? So it is a trading plan, and it is enforced by automated trading. So algorithmic trading is the process of using computers programmed to follow a defined set of instructions for placing trades in order to generate profits. That's a trading plan. So that is automatic trading, right? Algorithmic trading, there are many forms of algos. Some are automatic trading systems, some are black boxes, some are gray boxes, okay? So defined set of rules is based on, so any algorithm, if you ask any algorithm creator out there, any programmer, it is defined by a really strict, precise set of trading rules. Now, a lot of traders and a lot of beginner traders think that if they see a little bit of green in the market, they just jump in, or if they see a little bit of red in the market, they jump in, right? Either to the long side or either to the short side. But in reality, what they don't look and they don't assess is the market condition. They don't assess the risk parameters. They don't assess the target, because guess what? They hop into trades in the hopes of making, let's say, 1 to 2 ticks, let's say in the mini S&P, or 1 to 2 points. If trading was like that, I would not even get out of bed. I would never get out of bed just to make 1 point or 2 points in the mini S&P, or 3 points. I would not, okay? Because I want my knowledge to be put and to work in such a manner where I could get the maximum potential out of the market. So basically the defined set of rules is based on what? Timing, right? So that means that there is a certain tempo in the market. It is based on price. And remember that we teach 4 price points where you have institutional buying, institutional targets, or institutional selling. We also teach position sizing, which reflects quantity, which reflects position sizing for that specific environment and for that specific risk, right? Because if you have, let's say, a $10,000 account, that doesn't give you the right to say, hey, I'm just gonna take one contract because I have a $10,000 account, or I'm gonna take 2 standard contracts regardless of the risk of the trade, just because I have that account size. It's totally wrong. And then you're asking yourself, oh my gosh, why did I blow my account? Because I was just trading so well. I was just trading the standard size. That is not a standard size. The reality is that in trading, you have to evaluate the risk. The risk is the difference between your entry and your stop, and that is always going to vary depending on how the setup is forming. And of course, the mathematical model. So apart from profit opportunities for the trader, algo trading makes market more liquid and make trading more systematic, right? It makes trading systematic. What does it mean? Emotionless, right? It's ruling out emotion, human emotion that impacts the trading activity. So you can develop your own, everybody can. Everybody that is in here today with some of the knowledge that you have, even basic knowledge of trading analysis, you can develop your own algo, okay? The truth of the matter is that human behavior is having a very, it makes following your rules very hard. I mean, take a look at what's happening around us. You have a stay-at-home or shelter-in-place order, and everybody's going around. There was a funny picture on Facebook that I saw a few days ago where there were 2 images. One with a family, the mom was just looking at her iPad, was doing her shopping on her iPad. The dad was, looking at his phone. The kid was on the computer playing a computer game. And that was, on a normal day. And then under pandemic environments, everybody was going for a walk. Everybody wants to exercise. Everybody wants to go for a ride, with the bike. I mean, that's human nature. You tell a person not to do something and that's when they want to do it. Okay. So here's my approach to trading. This is my approach to trading in one slide. And this is exactly my model. And this is how I pre-plan my trade. My timing, and I'm going to go into detail about timing in the next slide. So I have 3 reference points, and this is the general market timing in the market. When the market opens at 9:30, that's where I am focused to see the price action reaction. I never place trades ahead of the open. So I only trade from 9:30. I'm just like an algorithm, okay? So I trade every single day in the trading room exactly like an algorithm. So I know exactly where my entry is and know exactly where my stop is. I know how to position size for that. I know where my target is. I have a management plan in place. Everything is stress-free. Literally, everything is stress-free. So the market opens at 9:30. At 10 o'clock, there is a major reversal time. So just remember this. And at 10:30, there's a minor reversal time. I'm going to explain that in a little while. And then I have my execution times. These execution times are based on over 20 years of research in the market and by trading the market, literally by trading the market every single day for the last 20 years, plus 20 years. These execution times, and these are the best execution times. They're 9:35, 9:45, 10 o'clock, and 10:30. Now remember these execution times and the timings in the market, this model right here, and I'm going to show you an example in the following slide. The pattern and quality, right? The pattern and quality. In a well-established market, I am focusing on 2 strategies. The pullback buy, the pullback sell. Definitely if we are in an uptrend or a downtrend, I'm not going to buy in a counter trend, not unless there are certain market conditions that I'm going to show you an example today. Breakouts or breakdowns. And I teach 10 strategies, but the go-to strategies, there are 2, and they're very simple. The others differentiate the algo from human trading. So you can take more advantage by being by manual trading, then you are an algo. But obviously this really simplifies your trading. Time frames. So what time frames are my focus? 2 minute, 5 minute, 15 minute, 30 minute, 1 hour, and 4 hour. I like to get my information from the 1 hour and 4 hour, and those are my analytical time frames, and even the 30 minutes. So 30 minute, 1 hour, and 4 hour, these are my analytical time frames. I focus on them before the market opens. I get all my information from these time frames, and then I'm trying to identify double triggers. Double triggers means I'm trying to find a trigger on the 2 minute that is coinciding with the trigger onto 1 hour or 4 hour. If I get a trigger on the 4 hour and it should overlap with the trigger, let's say on the 2 minute or a 5 minute, I'm taking the trade. And I have 75% or more odds for the success of that trade. Anything that is imbalanced on the higher time frames with the smaller time frames, the success of the trade drops to below 50%. I'm also evaluating my risk parameters, right? So I have risk parameters evaluation. So every single time you initiate a trade, you open the door towards risk. So that means you're opening the door for a loss. So you have to evaluate the parameters, and the parameters of the trade are always going to be variable. The only item that is not variable is your risk per trade, which should be the same on every trade you take, depending on your account size. That's why there are certain questions and there are certain things that you need to clarify before you actually open a trading account. What is the size of your account? What is your level of education, right? Because if you're just beginning trading, you should not risk 3% per trade. You should not risk 2%. You should not even risk 1% per trade. You should risk maybe 0.5% because you're just getting started. You need to discover your risk tolerance. You need to discover your strategy. You need to discover. You're into the discovery phase. The other thing is execution. The execution has these following steps: determining the entry, determining the stop, determining the target, determining the risk that we just talked about, determining the position size, right? Because according to the risk that you are applying, you need to position size for that risk. If the trade that you're identifying exceeds that risk per trade, right, you're not going to take it. You skip it. You just skip it and you wait for another trade to line up where you can take the trade. What if the risk is too wide compared to the amount that you're willing to risk on that specific trade? It should happen. And in volatile market environments, you're going to see that the risk is very elevated in all the trades. You're going to have anywhere starting in Nasdaq from a 40-point risk to a 160-point risk, depending on your time frame and depending on where the setup is forming, right? And then management. Management should be an automated system, right? We do, and I teach a management system, and I also give the guidelines into my trading room for traders that are just hopping in to the trading room without being priorly educated by myself, right? Without attending our courses. So we give them an idea of how to trail the trade, how to manage their trade, so they feel confident in the system and they don't see their P&L once green going back into the red. The Algo approach has certain benefits. Number one, it is stress-free. It is totally stress-free, and it really reduces anxiety. If you follow the rules, you should not feel any kind of anxiety. If your palms are sweaty, oh my gosh, you know what? That is the lack of confidence in your system, the lack of education, or over position sizing. If you feel stressed when you're in a trade, you're way over your head with the position size. And then you should take less of a trade. And remember, if you're a futures trader, you don't have any kind of excuse for not taking any trades, because the risk level remains elevated, because you have access to micros and you can position size for micros. Okay. And you have instant and accurate trade order placement. So again, we're following the same plan as for algorithmic trading, thereby high chances of executions at desired levels. That's what it means. Using limit orders. I never get in at market. I never, well, I should not say never, maybe once a year, maybe twice a year. I never hop into trades, never. The price is not moving that fast. Even in high volatility, it's not moving that fast. I always place limit orders. I know ahead of time, so from my pre-planning, I already know the desired areas. I'm going to show you some charts from today. I know exactly where I want to go long. And then after the open, if I have more information into the direction of the trade, I may change my plan ever so slightly. The trades are timed correctly to avoid significant price changes. So I know ahead of time where I'm placing my entry, where I should place my stop, where I have my target. So I know all this information 3 to 5 minutes, even under the conditions, even under volatile conditions. I know exactly where everything needs to be. So for those of you that are not futures traders, I specialize in the sweet spot. The sweet spot in the futures market is from 9:30 till 11:30. And that is because that is the overlap of the London session with the New York trading session. And the market at 9:30 gets infused with a lot of liquidity from the New York trading session. The volume goes up exponentially. Institutions are getting in. And therefore, you're going to see you have a very dynamic market. I do not get in trades ahead of 9:30. I do not get in trades at 8 o'clock. If you have been trading for a while, you probably know that at 8:30, you're having a big bulk of economic releases that are coming every Wednesday, Thursday, Friday, right? And they may influence the market. I don't trade news. I do not have the desire to consider the market as a casino. The market to me is a well-established institution where I know exactly when to get in, when to exit, right? So here's some basics about and differences about the futures market and about the stock market. I trade both. I swing trade stocks and I day trade futures. Why do I day trade futures? Because I have a plethora of opportunities. I take advantage of the 24-hour cycle in the market, close to 24-hour cycle in the market. Jay has a question, is overnight futures trading a terrible idea? No. In fact, we took an oil trade a couple of days ago, and it proved to be a fantastic idea because I called the trade at 2 minutes before 4 o'clock. We have an alert system out that is keeping in touch with our traders outside of the trading room hours, and they were alerted about this oil trade. Okay, they were alerted about this oil trade. So it is a very liquid market. I'm glad you brought that up because I can bring further information and clarify definitely that concept. The Asian session is typically a slower session. And it is not as liquid, but it's surely tradable. You are not going to day trade it because you're going to experience often stop outs. So definitely the time frames are going to be way different than for the New York trading session. You're going to look at higher, you're going to trade the analytical time frames versus the day trading time frames. So it has a lot of differences, but it's definitely tradable. The Asian market does not have algorithmic trading. It is the only segment in the market where you do not have algorithmic trading. Thomas, what about Forex? I have traded Forex for many, many years. on the institution side, and also going into my professional years in trading, where I'm trading from home. And the futures market is sort of like a blend between the velocity of a forex, of a futures market and a stock market. It's a blend. If I don't have a really a good preference and for day trading forex, and I think that overall, if you want to approach the forex market, you should approach it from the higher time frame perspective. What that means is that if you would like to, let's say, quote unquote, day trade it, which is not a great idea, the time frame that you would need to focus on, from my point of view and the way I was doing it successfully, was to trade higher time frames. Your 4 hour should become your, let's say, 5-minute chart. Okay. All right. So the futures market is open close to 24 hours, almost 6 days a week. It's going to close today in about 45 minutes. And you can actually take advantage of all the moves that are happening outside of the US stock market hours. Because guess what? Geopolitical events and any kind of international event does not wait for the market to open, even happen. And many markets that affect the US markets trade outside of the US market hours. So I would much rather trade something where I can have control. And especially now, when we're dealing with this pandemic situation, it is wiser to, if you would like to initiate swing trades, you can swing trade commodities, you could swing trade gold, you could swing trade oil, and have a handle on the risk, on the stop, on the trail within this 24-hour cycle. Because guess what's going to happen? You're going to have sudden, huge moves, either up or down. What happens if you're into a stock trade? You're going to have those sweaty palms because you have no idea. And especially now going into the weekend, if you're into a swing trade, that's a pure lottery. It's like going to the casino, right? It's pure lottery. You have no idea where the market is going to open on Monday. Is it going to gap up? Is it going to open flat? Is it going to gap down, right? And what is your direction into that specific stock or ETF? So you don't have a good handle because you're not going to be able to trail it in the overnight trading session, right? You're gonna have to wait until 9:30. You have your hands tied. Where in the futures market, you are hands on. What I trade. This is the whole panel of instruments that you can trade. I specifically specialize in these 4 indices: the Dow, the S&P 500, Nasdaq, and Russell. I use the VIX as my gauge. I do not trade the VIX. It is to me personally, they're super high risk. You can actually test them in a simulated account, and you can see I use these as a gauge. For instance, today I was looking at the VIX. I'm also watching, let's say, the VXX, because I'm a stock trader and I trade VXX. I don't trade the VIX. I don't do options, but I do trade the VXX, and I'm pretty much watching it like a hawk right now, because I have 2 levels where bullish above or bearish below. Okay. And it is getting very interesting. So bonds, I trade bonds. I trade gold. I trade silver. I trade copper. I trade sometimes, I could go into meats if I have the opportunity. These are not so liquid, by the way. But your main focus for day trading is going to be the futures indices. Gold is very volatile right now. It is really great for swing trading as well as oil. You could trade natural gas. You could trade a plethora of other instruments. So what do I trade? And actually, this is a slide from today. This is my watch list. So I don't have my watch list on a Post-it, or I don't have it on, a watch list on my platform. No, this is the way I watch it. So it's really hard to miss a trade when this is what you're watching, and you're watching your setups, you're watching your patterns, and you could see my algorithmic approach that I have here. So today, we had the bullish above level of 25.24. So over this 25.24, it never went there. We have the bullish above in Nasdaq over 57 and change, so 58 to 60. So we want it to be bullish. You can see it right here. We are bullish above this zone. You can see the signals, bearish below, bearish below. This is support. This is going to react as target with the prices associated to the area. And this is what I project in the trading room. So traders that join late, they see the levels, they can trade off of the levels. Plus, I call the trade. I take all the trades that I call. I only call between 1 and 3 trades a day. I take all my trades, and not only that I take them, but I post them 3 to 5 minutes in advance. I do the pre-market game plan at least 45 minutes before I call the trade, 30 minutes to 45 minutes before I call the trade, so everybody knows on what side of the tape I am. I'm also live on the microphone and trailing it. So it's a hand-holding system. You're not going to be left alone and say, oh my God, what am I going to do now? Oh, I hit target 1. Now what? Oh, it's going beyond target 1. What do I do now? So there is no guessing. I leave no guessing to my traders. So it's a hand-holding system. I trailed the trade. I entered the trade. I tell exact parameters for the entry, the stop, for the targets, and how I am trading it. And also, what do I do at target 1? What do I do at target 2? Where is the trail stop going to be placed? And all that fun stuff. This is an example of gold. So you could see here, I was teaching, so I started to teach the Power Income Futures day trading course this Monday. And we had this setup that was developing, and it was very interesting. And I mentioned it, that it is a breakout zone. You can see it right here. And we had this for the longest time, starting on Monday or Tuesday, I think it was. So Monday or Tuesday, this is the level that we have projected in the trading room. And in fact, if you guys want to double check what I'm saying here, you could go to my private Twitter feed and go to my profile, and you could see all these charts, Monday, Tuesday, Wednesday, and you could see the backtest, how they work and how they progressed. Okay, so that's a very simple step that you can take. You can see here, target zone, take profit area, resistance, caution, scale out, resistance, caution, scale. Okay, so definitely, does gold have more juice for another run up? Of course. Okay, this is another chart in the mini S&P from this morning, so you can see that we have clear parameters. This is support watch zone, so this is not a short right here. This was, by the way, not a short into the top right here, not a short into the top, so we didn't short it. So this was only bullish above 25, 24 zone, and this was a watch list, and this was more a bit under 2400. This is a bearish, actually 2387. This is a bearish below zone. Also, this is a trade that we posted, and notice when it happened right here. So our level was way before we had this level from here, actually from Sunday. We were watching this level, and I said, this is not ready for a continuation higher here. Let's just wait it out. And you can see that finally we had the breakout buy level right here at $21, right? So I don't need to tell you where the price of oil is trading right now. Okay, and by the way, we had targets. Take a look at these targets right here, 23, 24, 25, etc. So we have, I don't know if I have time to project targets, but we have to project some other charts, but we had targets into $30, $32, $35, and more. So time versus money, for those of you that are still trading stocks, remember, I come from stock trading background. There is a huge advantage in buying power. So let's say a trader wants to trade the Qs that are priced hypothetically, let's say at 212. You need about $12,000 or more to buy 100 shares. And if the price goes up 50 cents, then guess what? You're going to make $50. That's good money for, for 100 shares. But guess what? You only can buy 100 shares. But if a trader wants to buy, let's say the mini Nasdaq, which is priced, let's say at $86.91, the trader needs to have about $8,200 now because of the volatility. We have a bigger margin, but you need about $8,200 to buy a contract. And if the price goes up 50 points, you make $1,000 because each point is $20. Let me show you on charts what I mean. Okay, so we did this at the end of February, and we did this example. So We had a mentoring session with some of our students, and we actually bought. Okay, you can see here, this is the buy zone. We bought it at 233.10. We used $11,000, over $11,000 in buying power. And of course, the price went exactly into our target. So the trade duration was 40 minutes. The trade was entered at 11 o'clock. We were in the trade for about 40 minutes. It was a very sluggish price action for this ETF. And we bought it, of course, with 100 shares, right? The profit, you could see it right here. You could see the profit was $101. Now, I want you guys to look at something, especially those of you that are stock traders. This is the 10 EMA that I use. This is the 20. This is the 50. This is the 200. You can see them fanning out right here. And you can see the wicks to the top, the wicks to the bottom. And you can see this reversal happening right here off the 50 SMA. All right. Well, this coincided with another specific zone from a higher time frame. So trade duration, 40 minutes. I made $101 using about $12,000 in buying power. Changing the slide. If I would cover the symbol and I would cover the price at the right-hand side of the chart, guess what? You would literally say it's the same chart. Now, trade duration, same strategy applied for stock, same strategy applied for the futures, same topping tails, same moving averages. You can see same time frame right here. So we entered the trade at 11 o'clock Eastern. The trade duration was 40 minutes, and the buying power is 8,200 with one contract, $790. You can see it right here. Same trade, same duration, right? You can see where the price, you see where the price is trading right now. So it went up, pulled back, and it went back up. I'm going to go back one slide. Went down and went back up. This is exactly the difference in buying power. So if you know how to trade, you would rather, and I would rather trade for instant gratification than anything else. I'm also going to show you some charts, and you know, oftentimes a lot of traders love to say, hey, you know what, I got into this trade and I got into, I don't know, Nasdaq, and I made $2,000 or I made $1,000. Like I said before, to me, a really good trader identifies velocity opportunities where you could actually make your time in front of the computer count, and not going for the 1 tick or 4 ticks, or I don't even look at ticks, to be very honest. I look at the whole numbers, you know, and that's what I'm going by. I could care less about those ticks, especially in volatile market environments. To me, a trade that would equate to 3 points or 4 points is a break-even trade. I mean, literally, I consider it a break-even trade. I don't even look at that. I don't get out of bed for 2 to 3 points. So don't be fooled by a system that says, oh, it could generate you 8 ticks, or it could do this, without providing you information about the risk. How much did you risk to make the $1,000? How about if you risk, how would you feel if that trader risked $5,000 and made $1,000? Would you consider that a good trade? I don't think so. So I don't trade a lot of size, but my moves are generated by these velocity moves, by these really big continuation trades. And you can see them right here. So this is, by the way, and this is a trade that I did on my personal account. This was very aggressive, right? Because take a look, it was on March 25th, and we're still trading in high velocity right here. March 25th was still high velocity, and I took the trade in micros, and it was a little swing trade. I only had 3 micros, and you know what? I initiated the trade with 1 micro. That's right, I traded with 1 micro. And a couple of days later, and this is just in 2 days later, $1,200 on this trade. Take a look at Nasdaq right here, okay? So Nasdaq in comparison, because I wanted to compare apples to apples. So obviously I took it in a micro account, and then guess what? I took it in my own personal account. I position size for that, and I took it with 1 micro because I wanted to show traders that yes, you can make money with micros, right? And you can make a really good money with micros. So you can see it right here. 1 contract, just 1 contract. Again, here is another example. Take a look at the results right here, okay? And this is with 1 micro Nasdaq, one micro Nasdaq. Take a look at this result, one contract. And again, this is a micro. Again, this is a micro right here with one contract on the same day. This is price velocity. This is what I'm teaching, and this is what I'm trading on a day-to-day basis. Take a look at the date right here and take a look at the size, okay? And take a look at the symbol, right? NASDAQ, one contract, take a look at the result. Okay, again, the date, we're trading in volatile market environment, and the result, this was a day trade. This was a day trade. And it hit targets. It actually started off as a swing trade, but it hit targets in less than an hour, swing trading targets in less than an hour. You're wondering probably what this gap here is. It was a limit down. We went long. Take a look at the results right here. So yeah, we trade limit up, we trade limit down, but we don't take the trades. We don't post the trades when the market is halted. That is suicidal. So we go for high velocity moves, and we want to make sure that we want to capture the whole momentum. So you can see that if you, and by the way, if you go to our portfolio, which is on our website, it's under the trading room tab. If you hover your mouse, you can see the results that we actually put the results at the end of each month. And you could see our results from the first 3 months of trading, and actually the month of March, which has just closed the month of March. And it was literally my best trading month ever. The results were insane. The profits were insane. And note that the results are by contract, per one contract. So these are the types of momentums that we want to have our trades and to have our money into. So you can see that we waited. The market didn't do anything, and then we got in velocity. And you could see here that the parameters of the trade, the timing of the trade, etc. So these are the momentum moves that we do. This is another example of some trades that we executed in the room. All these slides right here that you see, these are all trades that were executed in the trading room. 100% all are in the trading room. So for those of you that are new to futures and maybe you want to look into it, I'm going to give you a little overview here. So I know that a lot of one of the reasons many traders gravitate towards the futures market is actually the low startup cost, because it usually requires you about $30,000 to open a stock day trading account, and you must maintain at least 25K to keep that day trading static, because guess what, you lose a penny, you cannot day trade it in that account. And you have to bring money from home. So the futures market allows you to open an account for as little as $5,000. And I know there are brokers that allow you to open accounts with $500 and you could start trading micros. I don't suggest that. And I don't recommend that. And it's always hard to trade with scared money. I consider that scared money, and you're never going to get results. I think you're going to blow account after account after account. There are other options that you can use if you don't have the funds to take advantage of that. And best of all, you do not have to maintain that account. So you open it with 5K. 5K is great if you want to trade micros. It's fantastic. And guess what? As long as you have sufficient cash in your account to cover the margin requirements to trade the commodity or the index, you could actually you could actually have a balance of $500 to $700. And guess what? You could still trade the index or the commodity. Okay, so these are some of the advantages of trading futures, and especially in a volatile market environment. You could trade micros, you can position size, you can offset some targets, you could scale in, scale out. You could have so many opportunities by trading micros. It is unbelievable. I wish we had them back in 2018. They're fantastic to trade in volatile market conditions. They're better than paper trading. They're great for scaling in and out. They're great for swing trading. They're great for position sizing, can be used in volatile markets to reduce the exposure. By the way, all the trades that you see in our portfolio on our website, all trades are based on only 2 hours of trading. And this is at the New York trading session. That's it, 2 hours. We teach and trade with a real structured approach. We teach and trade live every day, highly successful algorithmic levels that enable us to profit from momentum moves at specific times and precise patterns, 100% like an algo. Our methods override news events, any artificial indicator, earnings, dark pools, and you can see how our charts are super clean and super simple to read. At the beginning of the presentation, I promised you guys that I'm going to give you an example of a market tempo and possible price continuations and what you need to focus on. Okay. Steve, how many trades per day would be typical for the trading room? Maybe one or none, or maybe three at the most. Depends on the market environment. It's all about high odds trades. Okay. So the market opens at 9:30. If the market opens and it basically runs up, I don't know, maybe it runs up. If you're trading the S&P, maybe it runs up 5 points, 10 points, 15 points. I don't care. You can't run up 50 points. I don't care. Okay. I never jump in trades unless I see some kind of signal from my levels. I just watch. Just because the price is running doesn't give you the right to jump into a trade. And then I look for a pullback because 10 o'clock is major reversal time. So I look for a pullback into 10:30. 10:30, like I said, it's a minor reversal time, and it's also the prime time trigger time in the market. What that means is that if the pullback is shallow, on the next reversal, you could start jumping in the trade. Not jumping in, let me rephrase. You could start looking at a buy parameter and initiate the trade. The trade that initiates from 10 o'clock has a longer duration of life. Means that you may still be in the trade from 10:30 to about 11:15 to 11:30 or so. Okay. Sometimes you're getting a chop market, right? And in this chop market, usually market calibration from 9:30 to 9:45. Okay. And then after this calibration is done, then you can look for the swing from the swing low to the swing high, and then for a pullback, the same concept applies. This is an example. Remember, 2 weeks actually ago, we had the limit down and we had the bottoming in the market. Obviously, it's a temporary bottom. I mean, nobody knows if this is a temporary bottom. So far, it is a temporary bottom. Nobody knows if the market is going to start pulling back or what the case is. The weekly charts and candles are not very encouraging going into next week. And today, if we would have had the price over those purple lines that I showed you earlier, that would have been really great for the market because we would have had a much better bias for next week. Okay. So this is a trade that we've done. We had 923 points from the entry. Okay. You don't get trades like this every day or every year. Okay. Or you get these opportunities every several years, possibly. Okay, this is what one of my members in the trading room. So in the trading room, we have members that have very small accounts to huge accounts, and some of them are fund managers. So this is a message that he wrote to me last week saying, Anka, you are the most fantastic trader I've seen. I'm in Nasdaq and the Qs because we had a swing in the Qs in our program and in Nasdaq, long in our fund. Right, so he took it in their fund from a few days ago when you nailed the reversal. High velocity as his finest. We have multiple subscriptions to many other rooms and services, and let me tell you, you're the best. All right, we're the only futures subscription that he has. The rest, he uses the rest of the subscriptions to scan for scanners. So they basically all those services are doing the work for him. Okay. So basically what I do is I trade 2 hours a day, futures. That's it. And I know my pre-plan in advance. I trade with the trend on my side. Very seldom that I do counter trend trades, and those are very specific, like we did a couple of weeks ago in Nasdaq and the Qs long. It's time, if you haven't simplified your trading, it's time to look at your trading system and simplify it, because go back to the basics, guys. That's all I have to say. Go back to the basics. My strategy is to find really well established opportunities in the market for long and shorts in the first 2 hours in the morning. I have undivided attention in the first 2 hours. Literally, there's no phone, no internet, no service, no nothing. I'm not browsing the internet. I am like one with the chart. A few words about strategies. And the thing is that, you are, throughout your trading career, you're going to have, a lot of exposures to a plethora of strategies. Obviously, you're going to have to learn technical analysis. You're going to have to learn market dynamics. One of the most important things that you could do for your trading is learn how to use multi-time frame alignment, because that is where the secret, the keys to the kingdom, are. The keys are in multi-time frame alignment. Once you learn how to read the chart and how to identify pressure points to the long side, to the short side, that is when you're going to make it as a trader. You're going to learn to pinpoint entries with accuracy. You're going to learn how to establish the targets, how to establish the stops, how to control risk. You're going to learn a lot of things throughout your trading career. But the mastery is how to put the puzzle together. Very few traders know how to do this. And in fact, there are only 10% of the traders that know how to put the puzzle together. You have to be one of those 10%. You have to learn everything to know how to put the puzzle together. Okay, so here are trading results. Go to our page, TradeOutLoud.com/performance. We have a course that we're going to start teaching, and we have just an add-on to the course because this month was out of the ordinary. Like I said, this is the last day of the course that I'm teaching, and next week we're going into mentoring. And I teach the course, which is always live. You're going to have access to the on-demand recordings forever. You could actually download them to your computer. You don't even need an internet connection to review them. You're going to have the e-manual, platform layouts, risk charts, unlimited live retakes, and unlimited access to me. You have a question, you could actually come to me. It's not like you're going to have a course that's recorded and then bye-bye. I'm too busy to answer. No, you have unlimited access to me. So we teach everything from A to Z about how you can make a living into the futures market and how to trade. We take traders from any level. Actually, some of our most successful traders are traders that have never, ever traded before in their lives because they don't come with bad habits. But we teach you everything from A to Z. The 6 major disciplines about the, entry to stop, target, management, position sizing, etc., market tempo, how to maximize gains using key moving averages and other powerful indicators that are free with any broker, how to maximize gains and minimize losses using proper money management techniques, etc., etc. So if you're interested in the class, you could shoot us an email or you could go to our website. It is TradeOutLoud.com/futures. You can find more information about that. And our next class is April 27. We have open enrollment for this class. We already have, I don't work with a lot of students, so just FYI, we may run out of spots. We already had 5 individuals that already have registered, and they wanted to take the class, the live class this month, but there are no more spaces. So I'm only one person that teaches. So you can imagine, having traders call me or email me, or, having to, create the support for them. So if you're interested in the course, it's April 27th to May 1st. It's a 5-day online course. It is from 2 p.m. to 4 p.m. plus Eastern, depending on the Q&As. You're going to have access 30 days in the trading room. Plus, I'm throwing in 5 days live trading lab for those of you that are very new to trading or that are older to trading, but to get acquainted to how we create the levels. And this trading lab is $2,500, and we're waiving this. And if you want to sign up, you have until Friday the 10th to take advantage of this special offer. TradeOutLoud.com/futures. Thanks so much, guys. And I will be in touch with you.